Richard Wyckoff recognized the potential for lucrative risk-reward ratios when trading in markets that are range-bound. He developed a comprehensive approach to analyze and trade such markets. When a range is formed at the end of a prior trend, whether it was an uptrend or downtrend, it creates a balance between the supply and demand of the market. As a result, buying and selling activity is not strong enough to cause significant price movement in either direction. This type of range typically results in sideways price action over an extended period of time. Institutional investors and smart money traders, who Wyckoff referred to as composite man, often take substantial positions in these types of ranges. Accumulation refers to a market activity that occurs after a prolonged downtrend, in which the market trades sideways or within a specific range. During this phase, institutional investors and smart money traders attempt to acquire positions without causing a significant upward price movement. In essence, accumulation means that large players are purchasing stocks following a substantial decline while attempting to avoid significant price movement to the upside. Accumulation occurs in 5 distinct phases. Phase A signifies the end of the preceding downtrend, during which the supply had been dominant. The approaching decrease in supply is evident in the form of preliminary support, PS, and a selling climax, SC. These events are often noticeable on charts, where a widening spread and heavy volume depict the transfer of a large number of shares from the public to professional interests. Once the intense selling pressure has subsided, an automatic rally, AR, typically follows, consisting of institutional demand for shares and short covering. A successful secondary test, ST, near the area of the SC will exhibit less selling than before in a reduction in spread and volume, usually halting at or above the same price level as the SC. If the ST goes lower than the SC, one can anticipate new lows or an extended period of consolidation. The SC and ST lows and AR high establish the boundaries of the trading range, TR, and horizontal lines may be drawn to focus on market behavior. Although the downtrend may end less dramatically at times, it is preferable to observe the PS, SC, AR, and ST since they provide a clearer indication that large operators have commenced accumulation. Phase B aims to create a foundation for a new uptrend, adhering to the principle of cause and effect in Wyckoff's law number 2. During this phase, large professional interests and institutions accumulate inventory at relatively low prices in preparation for the upcoming markup. Institutional accumulation is a time-consuming process and involves purchasing shares at lower prices while short-selling to limit advances in price. In Phase B, multiple secondary tests, STs, and upthrust-type actions occur at the upper end of the trading range, TR, and the large interests become net buyers of shares throughout the evolution of the TR, intending to obtain as much of the remaining floating supply as possible. The characteristic up and down price action of the TR is a result of institutional buying and selling. In the early stages of Phase B, price swings are typically significant, accompanied by high volume. However, as the professionals absorb the supply, volume on downswings within the TR tends to decrease. When it seems that the supply has been exhausted, the stock is ready for Phase C. Phase C is the crucial stage in which smart money traders assess whether a stock is ready to be marked up. During Phase A and B, the large professional interests and institutions were accumulating shares in anticipation of the next markup. In this stage, a spring is observed, which is characterized by a price move below the support level of the trading range, TR, established in Phase A and B that quickly reverses and moves back into the TR. Although the drop below support seems to signal the resumption of the downtrend, it is a bear trap and marks the beginning of a new uptrend, trapping the late sellers. According to Wyckoff's technique, a successful test of supply through a spring or a shakeout represents a high probability trading opportunity. A low volume spring or a test of a shakeout indicates that the stock is likely to move up, so this is a good time to initiate at least a partial long position. The presence of a sign of strength, SOS, after a spring or shakeout confirms the analysis. It is challenging to identify Phase C when the testing of supply occurs higher up in the TR without a spring or shakeout. If our analysis is accurate, we should observe a consistent prevalence of demand over supply, which is shown by an arrangement of increases sign of strength, SOS, on expanding price spreads and growing volume, and reactions last point of support, LPS, on smaller spreads and reduced volumes. In Phase D, the price will advance to at least the top of the TR. LPSs in this stage are often favorable moments to start or increase profitable long positions. Phase A is the final phase of the Wyckoff method, in which the stock price breaks out of the trading range and experiences a clear and sustained uptrend, driven by strong demand. Any declines during this phase, including shakeouts and other reactions, are typically brief and quickly recovered. However, it's possible for new trading ranges to form at higher price levels as large operators continue to buy and sell shares. These ranges, sometimes referred to as stepping stones, may serve as intermediate targets for even higher prices. Distribution is the opposite of accumulation and occurs after a prolonged uptrend. During this phase, the major players in the market, such as institutional traders and smart money investors, attempt to sell off their holdings without causing significant price declines. This activity takes place in a sideways or range-bound market where the prices remain relatively stable. In simpler terms, distribution refers to the selling of stocks by significant market players after a considerable increase in prices, while attempting to avoid sharp downward price movements. Phase A is the first stage of a distribution trading range, TR, that signals the end of the previous uptrend. During this phase, the balance between supply and demand shifts, and the first indications of supply entering the market are shown by the occurrence of preliminary supply, PSY, and a buying climax, BC. Typically, this is followed by an automatic reaction, AR, and a secondary test, ST, of the BC, often with lower trading volume. However, the uptrend may also end without climactic action, instead demonstrating exhaustion of demand as the price spread and trading volume decrease. Less upward progress is made on each rally before significant supply appears. In the case of a redistribution TR within a larger downtrend, phase A may appear more like the beginning of an accumulation TR, for example, with significant downward price and volume action. However, the subsequent stages of phases B through A of a redistribution TR can still be analyzed in a similar manner as the distribution TR at the market top. Phase B in distribution is aimed at creating a situation that leads to a new downtrend. In this phase, institutional traders and big players initiate short positions and dispose of their long inventory in preparation for the upcoming markdown. The main points about phase B in distribution are quite similar to those in phase B in accumulation. However, in this case, the large players aim to sell shares as much as possible, in order to exhaust the remaining demand. This activity leaves clues that the balance of supply and demand has shifted towards supply. For example, signs of weakness, SAW, are usually accompanied by significantly wider spreads and higher volumes to the downside. Phase C can be identified by an upthrust, UT, or upthrust after distribution, UTAD. An upthrust is when the price moves above the TR resistance and then quickly reverses and closes within the TR. It tests the remaining demand and is intended to deceive breakout traders into thinking that the uptrend is continuing. The large interests use this opportunity to sell more shares at higher prices to the uninformed breakout traders before the markdown begins. Additionally, a UTAD can lead short traders to cover and give their shares to the large interests who engineered this move. It is often profitable to initiate short positions after a UT or UTAD, but it is risky because the smart money repeatedly stops out such traders with one UT after another. So it may be safer to wait until phase D and a last point of supply, LPSY. If the demand is too weak in a distribution TR, the price may not reach the level of the BC or initial street. Phase D occurs after the tests in phase C signal the end of demand. In this phase, the price moves to or below the TR support level. Evidence of supply dominance becomes more apparent with a clear break of support or a decline below the midpoint of the TR after a UT or UTAD. There are usually several feeble rallies during this phase, which represent great chances to start or increase profitable short positions. It is unwise to remain in a long position during phase D. Phase E represents the continuation of the downtrend, as supply takes over and the stock moves outside of the TR. When major selling occurs and breaks the support of the TR, it's often followed by a rally that fails at or near that support level. This is a chance for traders to take a high probability short position. Typically, the rallies that occur during the markdown are weak, and traders can adjust their stops downward as the price falls. After a substantial drop, there may be climactic activity indicating the start of a new redistribution or accumulation TR. In conclusion, understanding the principles of Wyckoff accumulation and distribution can be a valuable tool for traders and investors looking to identify trends and make informed decisions in the financial markets. By analyzing price and volume patterns, one can gain insights into the actions of large institutional players and take advantage of potential opportunities for profit. By keeping a close eye on the different phases of accumulation and distribution, traders can anticipate market movements and stay one step ahead of the game. So, whether you are a seasoned pro or a new trader just starting out, incorporating the principles of Wyckoff analysis into your trading strategy can be a powerful way to navigate the complex world of financial markets. If you liked this video, then please subscribe to our channel for more. If you